Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. This video presents a direct informational narration of the source document. Okay, let's get into our standard disclosure. This document is for informational purposes only. It doesn't constitute investment advice or a solicitation to trade in any way. And please remember, financial markets carry significant risks, price fluctuations can be substantial, and past performance is absolutely not an indicator of future results. So, here's our roadmap for today. We'll start with the panic selling in the Asia-Pacific session. Then, we'll look at how pre-market sentiment got repaired. After that, we'll dive into the intraday volatility, the technical setup, the macro crosscurrents, and finally, we'll wrap up with sector performance and risk strategy. All right, let's set the stage. The day's narrative was really framed by an incredible geopolitical whiplash that happened over just 48 hours. The main driver was President Trump's stance on Iran, which swung wildly from dovish to an extremely hawkish ultimatum. This caused some serious waves. The Nikkei 225 plunged 5% as investors piled into the yen for safety. In Korea, the Kospi saw such extreme panic that it actually triggered a circuit breaker. This whole open and crash feedback loop really created the perfect setup for the rebound we saw later. Now for the turning point. This is where things get interesting. The pre-market sentiment completely flipped, and it all hinged on a single headline. At 7 a.m. Eastern Time, this headline appeared on social media. It claimed, quote, "The United States and Iran had already reached a so-called 15-point consensus." That one sentence was the catalyst that changed everything. Let's break down the cause and effect here. That 15-point consensus claim, it sent U.S. equity futures soaring, recovering all their earlier losses. Strategically, this was just a textbook example of expectation management that squeezed out the short sellers. Then, the mention of a 5-day bombing suspension caused oil prices to collapse almost 13%, which forced quantitative programs to hit their liquidation thresholds. And finally, the idea of joint U.S.-Iran Strait management, that sent the VIX, the market's fear gauge, falling sharply from nearly 31, essentially pulling all the panic premium out of the market and triggering a rotation back into risk assets. But the roller coaster wasn't over yet. The main U.S. trading session turned into a real tug-of-war between the long side and the short side, as everyone was trying to verify these conflicting reports in real time. So you had two competing narratives driving the market. On the one hand, the long side pivoted on Israeli media reports that Iran had agreed to freeze its missile program for 5 years, and that pulled indices higher. But then, the short side jumped back in when the Wall Street Journal reported substantive military deployment, specifically that the USS Boxer was accelerating toward the Middle East. It was rumor versus hard fact, and the market was caught right in the middle. Okay, so let's shift gears and look at the technical setup and flow dynamics. The key takeaway here is to be very wary of what's called false liquidity. So what is false liquidity? Well, it's when you see what looks like strong trading volume, but it's not genuine buying or selling. It's actually being generated mostly by market makers who are hedging their own positions. Instead of providing real support, this just ends up amplifying volatility. Let's look at the psychology of the different players. You had the shorts, who were forced to cover their positions at the lows, and that really provided the launchpad for the rebound. Then you had the institutions. They didn't commit any genuine new capital, they just hedged for violent moves using straddles. And finally, you had the retail crowd. A lot of them capitulated on Friday, and then they were forced to chase this rally, which created some very, very fragile support. Now let's zoom out to the macro level, where we're seeing this theme of time distortion. Everything is being compressed because of quantitative or algorithmic trading. I mean, just look at the VIX. In a single day, it went from a high of 31 all the way down to 20, and then bounced back to close around 25. A process that used to take days or even weeks is now happening in a matter of hours, all thanks to these quant systems. The 10-year Treasury yield also tells a story. It peaked at 4.45%. The key level to watch is 4.3%. When the yield is above that, it acts like a mechanical drain on liquidity from the equity markets. And that massive 13% drop in oil, that wasn't really a fundamental shift in supply and demand. It was a deleveraging event. It was driven by quant liquidations. The real fundamental test is whether oil tankers can actually navigate the Strait of Hormuz safely. Okay, let's wrap up with a look at sector performance and a discussion on risk strategy based on everything we've seen today. One area that really stood out as a defensive growth haven was commercial space. Lunner, or Intuitive Machines, surged 14%, and Stifel actually raised its price target to $22. Planet Labs, ticker PL, jumped a massive 25.5% after its earnings. The thesis here is pretty straightforward. When ground assets feel threatened, satellite intelligence and lunar infrastructure can act as a haven. Separately, the Russell 2000, the IWM, rose over 3.7%, mostly because falling oil prices gave a temporary break to fears about rate hikes. So, what's the actionable guidance from this? First, on position management. Use this rebound as a window of opportunity to reduce any oversized or leveraged exposure. Second, on tactical timing. Keep a very close eye on Friday. That's a key date where geopolitical pressure might ramp up again. And third, a core observation level. Hold off on adding any new long risk until the S&P 500 can reclaim its 200-day moving average and does so on high volume. And this really sums it all up. Maintain a defensive posture and preserve adequate liquidity. In a false liquidity market that's dominated by hedging demand, the number one priority is to avoid becoming fuel for the next quant-driven liquidation. And as a final reminder, the author of this material is not a registered investment advisor, and this does not create any sort of client relationship. Any decision you make is completely at your own risk. You are responsible for conducting your own independent research and due diligence.